What is an income statement and what does it measure? I'll talk about that in this video. Hi, my name is Katherine. I'm your accounting tutor and I help accounting majors like you through graduation and beyond. An income statement shows all of a business's revenues and expenses for a period of time, along with their net income, which is simply revenue minus expenses. This is then used by a variety of people to evaluate how well a business is doing, along with other reports we'll talk about in future videos. The purpose of all accounting reports is to help users make decisions about a business. The income statement in particular is best used to evaluate changes over time, which is why the income statement is always for a range of dates, such as for the year ended December 31st, 2023, or for the month ended January 31st, 2024. I hate to say always and never in accounting, there are so many exceptions, but I'm saying it here. The income statement is always for a range of dates. Seeing on the income statement how much service revenue a business has this month compared to last month can help owners and managers make decisions about things like advertising expenses or hiring and firing decisions. If we want to maybe increase advertising, see if we can get more revenue, maybe our revenue is up so much and our workers have way too much work to do, we need to hire some more people in, or maybe the business isn't doing that well and we need to think about cutting back on our staff and some firing or decreasing expenses in other ways. Seeing the income statement period to period, making those comparisons is how people make decisions. Seeing the size of their rent and utility bills over time in comparison to service revenue could also help them make decisions about moving to a bigger location or maybe scaling back and moving to a smaller location, just depending on which way it's going. Seeing the change in service revenue and cost of goods sold over time can help us make the decision to increase our prices based on the increased prices of the materials that we use to make it, or potentially look for another supplier who can get it to us for cheaper. Again, more examples of how the income statement helps us make decisions. The income statement is also used by banks when evaluating whether or not to give a business a loan, which would be a liability to the business, and it's used by potential investors who are thinking about investing into the business and buying that stock, that equity into the business. Liabilities and equity, as you'll remember, are the two ways that businesses pay for all of the assets in the business. Everything comes back to the accounting equation. Back to the income statement. Every account that exists goes on either the income statement or the balance sheet, never both. One way we know which accounts go on the income statement is because income statement accounts generally have the words revenue or expense in them, but not always. Things like service revenue, sales revenue, those go on the income statement. All of our expenses, salaries expense, rent expense, utilities expense, those all go on the income statement. And so, as you've seen, they usually have those words revenue and expense in them, but not always. Notable exceptions include prepaid expenses, which are an asset that go on the balance sheet, and unearned or deferred revenue, which are actually liabilities that also go on the balance sheet. Cost of goods sold doesn't say revenue or expense in it, but you can think of cost of goods sold as inventory expense, and that actually does go on the income statement. Another way to think about which accounts go on the income statement is the accounts where it would make sense for it to reset on January 1st go on the income statement. For example, it makes sense that service revenue would reset to $0 on January 1st so the company can keep track of the revenue that it makes in the new year. If your service revenue account never reset, you could see something like $20 million in service revenue for a business that's been around 30 years, and that's not helpful for us to make decisions now. To make good decisions, we need timely information, which is why our revenue and expense accounts reset every year. Revenue and expense accounts add up all the revenues and expenses that we have over a set period and are rarely subtracted. The main reason we'd subtract from them is to close the accounts for the period with our closing entries, and that's the reset I've been talking about. Balance sheet accounts do not reset, and if you think about it, it makes perfect sense. Things like cash. Your bank account balance doesn't magically go to zero on January 1st, and how thankful are we for that? And same thing, accounts payable, accounts receivable, money that people owe to you does not get reset to zero. Money that you owe to other people also does not magically go to zero. So that's one way that can help you keep them straight. So how do we close accounts? First, we identify which accounts we need to close, which, as we've discussed, are the income statement accounts. This is the trial balance from the same business that I've talked about in previous videos, Account on Me. We already created the journal entries and the trial balance, and now we're trying to create the income statement. But before we can do that, we need to close out our revenue and expenses. In this case, since it's a very bare bones business, we only have a few income and expense accounts to close out. We have service revenue here, and we have advertising expense here. So how do we close it out? Well, first, we do what we need to do to make that account zero. So we'll close it out as of January 31st, and we'll close out the account of service revenue. You'll see that it currently has a credit balance of $175. So in order to make service revenue have a zero balance, we need to debit it. So here I'll debit service revenue for $175. Now, what's the opposite end of that entry going to be? What's the credit? Well, enter income summary, which is a temporary account, which lasts for exactly as long as it takes us to close out the entries. So we have service revenue debit of $175. We're going to credit this new account, income summary, also for $175 to balance out our journal entry. Now, if we had multiple revenues, we would debit all of them in the same journal entry and credit income summary. As it stands, we just have one, but if we have more, we would do it all in one entry and not account by account. Now we deal with the expenses. We only have the one expense right now, advertising expense. So same date. Now advertising expense is already a debit, so in order to make it zero, we need to credit it. So I'll jump down a line because debits are always listed before credits. This is just a stylistic thing that the powers that be have decided debits go first, credits go second. So that's why we're doing that. We'll credit advertising expense for $100. And as we talked about before, we have this other account, income summary, that will debit also for $100 so that our debits and credits equal each other. And like we said, if we had multiple expenses, they would all get credited here. Because we don't, it's just this one. From here, we create the income statement, which is going to be super simple for this business that doesn't have much, but I'll tell you the general format, and that should help. First, you put the business name on top. So we have our account on me, business. The second line is the name of the statement. So in this case, income statement. And then the third line is what period or date you're talking about. As we discussed earlier, income statement is always for a range of dates. And in this case, it's for the month ended January 31st, 2024. We start with our revenues as the header, and then we list all of our revenues underneath it. In this case, we just have the one revenue, service revenue, so that goes up top with 175 as our number. And then we total it for total revenue of 175. And then we list our expenses. In this case, we just have the one advertising expense of 100. And again, we total it. Advertising expense of $100, total expenses $100. And then we have our net income or loss. And we do revenue minus expenses, as we've been talking about. 175 minus 100 is going to give us a $75 net income. Now that we've finished with the income statement, we'll focus back on the journal entries. I moved over ledgers with just the total from the trial balance up above down here. So we have our service revenue, credit 175, advertising expense, debit 100, just like it is up here, and our income summary, which is blank. So right now we'll move these two journal entries that we just made into the ledgers. So service revenue, we debit 175, which gives it a $0 balance because the debits and credits equal. The other half of this entry is income summary, which we credit for 175. So I'll put that here under income summary. And then the next journal entry debits income summary. And so it'll be a debit of 100 and a credit to advertising expense. In advertising expense, the debits and credits equal each other out, so they have a $0 balance, which is exactly what we wanted to do. We're resetting it as we talked about. Income summary, it's the 175 credit minus the 100 debit to get us this credit of 75, which matches our net income. Well, income summary, as we talked about before, is actually a temporary account. It can't stay here forever. We need to get rid of it. Income summary closes out to retained earnings because, as we talked about before, net income ultimately increases retained earnings. And this is the process of how it does that. Currently, there's a $75 credit in the income summary account. We're going to make another journal entry to close out income summary. So because it currently has a credit, the date's going to be the same, 1/31. We're going to debit income summary for $75, which will zero it out. See, now our credits equal our debits, equals out. Next, we're going to credit retained earnings because, as we talked about, net income ultimately increases retained earnings. Retained earnings is an equity account. Equity goes up with a credit. Credit retained earnings for $75. And so that'll be the final balance over there. Our debits and credits equal on this journal entry. Income summary is gone. Our net income is in retained earnings. And essentially, we're done with the income statement. And there you have it. That's the basic of the income statement. We'll be talking about other statements in future videos, but for now, if you want an ebook that explains everything about the income statement and also the balance sheet, check a link in the description below, and I'll see you in the next video. Thanks. Bye.